All right. Yeah, thanks for the introduction. Okay, good to see your crowd here. Before I start, I'd like to get to know your demographics better, so I know how deep I can go. Okay. I like. How many of you already started investing in at least Malaysian market? Raise your hand. Malaysia market. Okay. How many of you have started with a US market? Raise your hand. Okay. Anyone have already started trading options? Traded options? Oh, a few of you. Okay, great. Who has not traded options but you have heard about this thing called options? Raise your hand. Okay, great. So this gave me some idea on how I should go. I think irrespective of whether you are totally new, right, or you have traded in the stock market, I think it's still good to understand what is options like. Okay. However, I would advise you that this is a more advanced instrument. Okay, it's more sophisticated. So before you straight away go into options, you need to learn about stock market first, right? But since my topic is about options, I have to go straight into options, right? It is still, I'll do my best to explain in a more layman manner, okay? So more of you can understand. And towards the end, I will answer questions. So hold on to your questions. At the end, if you have any jargon you don't understand, you can ask me. Right, so the topic today is about maximizing your portfolio growth with options. 80% of my trades are in options. Okay, I started trading the stock market way back in 1993, right? So Malaysian market, then to US market. But I started trading options actively in year 2005. That's 19 years ago. So I've gone through many different cycles. I mean, options is very advanced. It has many ways to trade options, many different strategies. And over the years, I've traded options over many different market cycles. The bull run, the crash, the choppy market, the stable market. And it's actually quite a steep learning curve for me, okay, even though I've attended some classes. So over the years, I realized that you don't have to trade all the different strategy, okay? You trade those, there's only a handful that is worth trading, okay? And I systemize the trading strategy for options to make it so much more simpler, right? Rather than attempted to trade all strategies. So I'm going to help you to understand options in the simplest manner, right? Right. So can I have the, right, thank you. Okay, so before I start, just want to share, you know, we have a company called 𝘊𝘂𝑚, which is an educator. It's the most complete education provider you can find in the market on investing and trading education. Okay. However, we are not an investment advisor. Investment advisor require a license, right? For example, like the broker license. So we are here to educate. I will be sharing with you my personal trades. So it's not for you to copy and trade on Monday. Whatever stock I share with you, you need to learn that the timing is important, right? These are past trade. Doesn't mean you can trade after this. And also, we assume no liability if you go and buy yourself. Also to protect moomoo as well, right? Right. So the invited speaker like me, right? These are all my my trades. And it's not an endorsement from moomoo, okay? I do my best to share as much live example as possible. All right, so this is one of my favorite photo, which is trade peace of mind, okay? Yeah, options is a tool that can allow you to trade and invest with peace of mind. To the extent that you can go and relax. This is Maldives. Yeah, one of my favorite place to go for vacation. When I have positions using options, I don't have to worry because it's protected. How many of you wish to have that, right? You have investment positions and you don't have to worry. You know the maximum risk you can tolerate already. Anyone? Right? You don't have to worry, okay? So some of you want to worry. You didn't raise your hand. Right? Is it okay? I know that when it's a new crowd, there's less response. Malaysian not used to raising the hand. Is it okay that you play with me on this? Right? Thank you. I like an interactive session. Yeah. So I know this is may seem too good to be true. Understand? That's why you may not have raised your hand. I will share with you why it is achievable by you understanding options in a short while. Okay. So the objective of this session is, I have 5 objectives. The first one is to help you understand options in the most layman manner first. And to demystify some of the basic options, there's a lot of jargon. But at the basic level, it's still understandable. Okay. So there's something called call option, put options, and there are many options combination. So I will share with you. So I hope that at the end of the day, at least you can take away, you understand what is a call and a put. Okay. The second part is to understand the power of options in terms of using less money to make more money. Okay. The third one, to me, is the most important. It's about risk management. Options can allow you to manage risk better than any other instrument. Okay. The fourth one is I will share with you a balanced picture about options. I've traded it for so many years. I know the pros and cons about options. So I will share with you the big picture so you can understand the benefits and the disadvantage. And also, last but not least, I will give you some example of the real world case study. Okay, I extract those that are simpler for you all to understand, even though I have a lot more advanced trade, which I will reserve it, unless you have more questions about that. Okay, so these are the focus on my presentation. Okay, all right, let's start with why options. Before I talk about why options, anyone here has any idea why this instrument is even called options? Anyone? Why is it called options? Yeah, to those of you who totally new to stock market, options is another way for you to buy stock. So instead of buying stock directly, let's say you want to buy Apple stock. Instead of buying Apple stock, you can buy Apple option. Okay? Yeah, so just another way. And the reason it's called option, there is so many options on how to trade it. That's why it's called option. Just in case you're curious, why is it called option? And I will share with you the benefit first, then I will demystify the calls and the puts. So the benefit option is leverage. Let's say if you buy Apple directly, you have to pay, right? For US stock for Malaysian is expensive, right? Yeah, so Malaysian stock, you can look at it, you can find it from a few cents all the way to, let's say, 20 ringgit considered expensive stocks in Malaysia. But in the US, it could be even from $1 all the way to more than $1 US dollar. But the good part is you don't have to buy in one lot concept like in Malaysia. In Malaysia, one lot is 100 units, right? In the US, you can buy 1 unit or 2 units. Now you can have fractional shares. You can buy fractions of a unit. However, in options, there's still a lot concept later on. Okay. So one of the benefit is leverage. Later, I will share with you an example you will understand better. In general, if you buy $100 stocks, right, you will have to pay $100 per unit. But if you use options, short-term options, it's only between 2 to 6% of the stock price. 2 to 6%. Right? So if you pay 2 to 6%, maximum loss is 2 to 6%. That's how options work, even if you don't have a stop loss. And if you go for long term, between 8 to 20%. Long term as in 1 year. 1 year, okay? Then it will be to 20%. So you have the leverage because you money, it reduces the cost, it make it more affordable. Your ROI better investment when the stock goes up. The second benefit is protection. This is my favorite. Okay? There are much more ways to protect your specific stock or your entire portfolio compared to just using stop loss, right? If you don't understand options, how do you manage your risk for individual trades? Normally, people will recommend put a stop loss. You buy here, you put a pending order in the broker that says stop loss here, right? You buy here, stop loss here, so when you're sleeping, when it comes to a stop loss, automatically it will sell for you. Okay? So those are the features available even in a moomoo platform. That's the reason why you can have a peace of mind, go for vacation. However, stop loss is not guaranteed. Even though reach that level, sometimes the stock gap down, right? Because let's say they miss earning, it gap down to this level. You can still lose more than where your stop loss is. But in options, you will be fully protected based on that level. Right, you already know your maximum risk the moment you buy. Okay, so that's the reason for this. And I use some advanced portfolio hedging as well. Let's say I have many tech stock, I can also buy a protection for my entire portfolio, like an insurance. In options, there's a concept of insurance that a lot of people doesn't know. I will show you some example later. Okay, and last but not least, give you many ways to make money from the same stock chart. Example, if you know how to trade, let's say you buy at support, sell at a resistance. But in options, with the same stock chart, so many ways. Okay, later I will show you how many ways. So with that, you have ways to make money from the same opportunity. And one of my favorite is, you can make money even though the stock says, let's say you buy a stock is at $100. Okay, for you to make money in stock, the stock has to go up, right? If the stock don't go up, you don't make money. But options, there's a way for you to make money even though the stock stays like this. Okay, of course stock seldom don't have heartbeat, right? Stock will fluctuate. Let's say by the end, there's a concept called expiry in options. By the end of the expiry, if it's at this level, you can still collect an income. It's called options premium. Yeah, so that's a strategy that no other instrument can accept options. Yeah, that's why I love options, especially investor. It's actually a waste if you don't learn this. This is a very good strategy. Okay, so now let's start with, so those are the benefits. So now let's start with understanding what is option first, so that you will believe those benefits, right? So what is option? In essence, there are two basic options. Right? It starts with this foundation before you go more advanced. So let's start with a call option. Right? There's a call option and a put option. To simplify, call option is for you to make money on the way up. That's why to trade up. How to trade up? I give you the technical definition, so I will simplify it later. This is the definition in the contract. When you buy a call option, example, let's say you want to buy Apple stock, but instead of buying Apple stock, you buy a call option Apple stock. Okay? What it gives you is, when you buy the call option, you pay less, let's say 10% of Apple stock. By paying 10%, it gives you the right, but not the obligation, the right to buy the stock, the underlying asset, means the stock. Okay, at a certain price by an expiry. So you can choose, the simplest example is like buying a house. Okay, let's say you want to buy a house 500,000. Do you pay full? You pay a deposit, right? You pay a 10% deposit for the house. By paying the 10% deposit, what is your right now? After you pay a 10% deposit for the 500,000 house, it gives you the right to buy the house at 500,000. Do you agree? Lock in the price. Right? That is the price at a certain price. Okay? Do you have forever to pay the remaining? How long do you need? How long do you need to pay up the remaining? Normally about 3 months. Right? You're supposed to go out there and borrow a bank loan, right? Yeah? Yeah. So the seller won't wait for you forever. So that's called the expiry date of the contract. Yeah, I want to do something that you know, so that it's simpler for you to understand options. The same, right? You pay a down payment for your house, which lock in the selling price, but you don't have forever. You have 3 months to pay the balance, right? You only have 3 months to have this right. After that, you pay the balance. The seller can sell to someone else. Understand? Yeah, quite similar concept. So, but in stock, how does it translate? If you pay a 10% deposit, you lock in the price of Apple. You can say, I want to have the right to buy Apple at 100. For how long? I want to have the right for 3 months. If it's for 3 months, the amount could be lesser. Let's say for 3 months, it could be $5. But if we say 1 week, it could be $15. But if it's for 1 week, it could even be $2. Right? So it depends on how long. So options give you many options. That's why it's called option. You can choose to have the right to exercise this right in 1 week, 2 weeks, 3 weeks, 1 month, 2 months, 3 months. Then there's an increment to 6 months, 9 months, 1 year, to a maximum of 2 years. Right? These are all the choice you have in the exchange. Right? Stock exchange, there's an option exchange. You have all these choice to choose from. And depend on how long is the expiry, the price will be different. Later on, I will show you the listing. You understand the concept so far? Yeah. Okay. So then there's another thing called put option. One is to trade up, the other one is to trade down. Right? The definition is almost the same, with one word different. The word, detect the word that is different. There's one word different from, like, buy to sell. When you buy a call option, it gives you the right to buy at a certain price. When you buy a put option, it gives you the right to sell at a certain price. This one is a bit tricky, right, to understand. So the closest way to understand this is buying an insurance. Okay, example. Let's say if you buy a car, 100,000 car, you need to buy insurance, right? Right, 100,000 car, let's say you pay 3,000 insurance, comprehensive. And let's say your car gone missing. Your car gone missing. So can you claim from the insurance company? Are you following? Like you can claim how much? Let's say you insure at 100,000. You can claim back 100,000. Okay, but can you get back your 3,000 premium? No. Okay, the concept is quite similar. Buying a put option is like buying an insurance on your stock. Let's say you have Apple stock. Okay, you bought the Apple at $100. Okay, of course Apple is more expensive than now. Let's say you buy Apple stock at 100, but you're worried about earnings announcement. They miss earning. You're worried about in China their sales is bad. You're worried about Huawei coming back. You're worried about all the macroeconomic factors. But now you want to go to Maldives and have vacation like me, okay? So what do? You can buy a insurance on the stock. So you buy a put option. What is the premium? Later on I'll tell you premium. You buy a put option on Apple, it will give you the right. I'm a buyer of the put. It gives the buyer of the put the right to sell the stock at a certain price. So I can say I have the right to sell Apple at $100. Okay, $100 by paying a premium. Why is it called a premium? It's like insurance premium. So how much do I need to pay? It depends on how long I want to protect. Let's say I protect against the next week there's a Federal Reserve announcement, right? So that one likely going to be good news, okay? So let's say there's a election, right? You're uncertain about the election. So you can buy a put option to protect your Apple stock. So how long do you need to protect? Let's say election is November, right? You don't need to buy so early, right? 2 weeks before November, you will buy a protection of 2 weeks and it will take some time to stabilize. You can buy, example, a 2 months expiry option. So to protect the entire, 2 months, entire 2 months before election, after election to stabilize. So when you buy that put option, let's say because 2 months you will pay roughly 5% of stock price. That's from my experience, okay? The actual code will be in the platform. You'll pay about 5% of Apple price to protect Apple. Insurance premium. So if let's say Apple stock dropped 20%, right? Drop 20%. From $100 drop to 80, you still have the right to sell at 100. You understand? Because you bought the put option. By buying the put, you get the right to sell at your insured price. This insured price is called the certain price. Technically, it's called the strike price. So how much it costs depends on how long you want to protect. Just like if you buy a car, protect by 2 weeks, cheaper, right? 1 month, more expensive. 1 year, more expensive. Okay, so it doesn't mean that you must, you can always take your insurance to the market. That means after the election, it's stabilized, you don't need the protection, you can sell back your put option in the market. It's not completely gone. Okay, can you understand so far? Right, just treat it simple, it's like a insurance. Okay, so there are 2 ways to use the put option. One is you already have the stock and you buy a put option. The other way is you don't have the stock, you just want to use the put option to trade down. Yeah, because once you buy the put option, you will expect the stock to come down. Once you buy the option and the stock come down, this premium will become more and more valuable. Right? This contract become more and more valuable. Why? When the stock goes further down, you still have the right to sell higher. Don't you think the contract is valuable? And because of that, this contract in the market will be worth higher. So let's say you buy at $5, when it goes down, when the stock comes down, you can even sell at $10. That's how you make money from put option. Okay, not as an insurance for speculating it to go down. Understand so far? Right, this is a high level concept of call and put option. Alright, so let's move on. So the simple analogy I can also give to you is later on I will talk about the Apple stock. Let's move on. So how does buying and selling options work? Let's say you want to buy Apple option. You must be thinking it's going to go up, right? If you think that this stock, let's say Apple, will go up in 1 month time, then you will buy a call option. then who will be the opposite person who sell to you? It's like stock, right? You cannot buy a stock if no one wants to sell to you. Someone need to be on the opposite side. So the other person could be thinking, they think this stock will go down instead of up. So they sell to you. Right? Either go down or sideways, they will still sell to you. So one distinction for options compared to stock is this. In stock, you only trade up or down. In options, you can trade up, down or sideways. Buyer is direction. Buyer only make money up or down. If you are seller, it stay flat, you still make money. Okay, example, let's say you pay $5 expecting Apple to go up, but Apple doesn't go up. Then the seller make the money. Okay? Yeah, it may be a bit advanced for you to understand, so let me move on first. So between the buyer and seller, you need a broker like moomoo. Okay, moomoo will be launching options soon, sometime by end of this year. Okay, so they will have this as well. Alright, so remember the simpler one is buyer make money on the way up, seller for the call make money sideways to down. Okay? Alright, so just now I talked about what is call and what is put. Okay? For call option, you have buyer and seller. Put option, you have buyer and seller. Okay? So it's a bit technical right now, but just to give you some overview. If you don't understand this, it's fine. It's a crash course, okay? Yeah. So let's say you are the buyer. The most important thing you need to understand is it's better to be a buyer if you want limited risk. Options can be risky as well if you become the seller, right? Because only the buyer, right, have the right but not the obligation. That means if the price not in your favor, you can choose not to exercise your right. Example, let's say instead of buying Apple stock at 100, you decide to pay $5 to buy the Apple option. Okay, you buy Apple call option which give you the right to buy Apple at 100 later. Let's say 3 months later. So an Apple dropped by $20. Okay, you still have the right to buy 100, but will you buy? You won't. You would rather buy at the market at $80, right? So now you have the right not to exercise your right. You just waive the $5. Make sense? So your maximum risk is how much? $5. That's how you can have limited risk. Make sense? Yeah. So that's the reason. But if you are the seller, you have unlimited risk. Okay. Let me see. Because you are the seller. Let's say I'm the buyer. I pay $5 to the seller to have the right to buy Apple share at 100. I pay him $5. I want to have the right to buy Apple share at 100 until 3 months later. Then Apple share actually went up. Apple share went up to 120 right now. So what happened to the seller? It's obligated to sell to me even though now the stock is 120. Would he be losing? Losing. Did he have the stock earlier? Have the stock earlier, okay, I just sell to you at 100, but he will miss the opportunity to make the 20. But what if he don't have the stock? He's a speculator. He don't have the stock. He just be the seller. It's called naked seller. It's called unprotected seller. Okay? So how does he fulfill the obligation? He don't have stock, right? But you have the right, right? I have the right to buy from him at 100. So he has to go to the market, buy at the market price, 120 and sell to me at 100. Will he lose money? Yes. The higher Apple, the more he lose. The seller, you need to understand seller has unlimited risk upside. Buyer, because you are obligated. That's the difference. Buyer, not obligated. You have the right, not seller obligated. Understand? Yeah. But there are many ways to become a seller. Options has so many ways to use it. This is just a simple terminology. There are conditions to be a seller, protected seller. Okay? Because, example, right? In what situation, more layman version, in the day-to-day life, let's say you want to buy an iPhone, okay? But the store, usually I buy my iPhone in a Maxi store last time, before I buy online. So let's say you go to any of these stores, assuming this is a Apple store, okay? You go in, you want to book, but not released yet. You want to buy the next iPhone. Okay, you know there's a next iPhone release, right? You pay your booking fee, so the seller here will receive your booking. Understand? Yeah, so you receive a booking. So by the time Apple release the phone, you will secure the current price. Agree? You secure the current price. So if Apple price go up after that, can he charge you more? Cannot. That's the concept. Make sense? So as the store seller, I'm obligated to sell it at that price. Okay? Even though Apple price is higher right now. What if I thought that, I want to take advantage of exchange rate. I thought, oh, exchange rate going to come down. Because US dollar going down compared to ringgit. He don't book with Apple yet. He don't book with Apple US yet. Okay? He wait for a while, expecting the ringgit to strengthen. Then he can buy cheaper and sell to you. He can make more margin. Is it possible? But what happened is exchange rate go up instead of down. I mean, US dollar went up. Will he have a loss? Yes, because he still have to sell to me at that price. So that's the kind of risk the seller need to assume. Right? So you need to understand the buyer and seller. So as a beginner, it's always good to start as a buyer. Yeah? Because it's limited risk. Okay? So, yeah. So the put option is a bit sophisticated. As I mentioned, put option also have buyer and seller. Right? In simple terms, put option is used to trade down. Okay? But I am buying, this is the way it mind trick. When you are trading stock, how many of you have traded, make money on the way down on stock before? Shorting. Anyone have traded shorting? 1, 2, 3, right? Yeah, so when you want to make money, a lot of people don't know that you can make money on the way down using stock. So let's say the stock is 100. You think it will go down to 80. You just sell first. Sell at 100, buy back 80. Okay? That's called shorting. Why it's called shorting? You don't have stock. You start with sell. That's why it's called shorting. You sell 100, come to 80, you buy back. You do it the other way around. Just like the handphone shop, right? He sell to you first. He don't have stock. Okay? Yeah, later, he will buy back from Apple. Yeah, so that's the concept. But in put option, the way to trade down is you're not selling, you're still buying. Just that you buy a put option. Okay, so you buy, when you think that Apple will go down from 100 to 80, you buy a put option for Apple. You may pay around $5. This $5 give you the right to sell Apple at 100. So when Apple go down to 80, this contract will be worth more. It will be worth at least $20 because now you have an advantage of $20 over the market. The market is 80, but you can sell at 100. You have $20 advantage. Your put option will be worth $20 right now when you sell, but you only bought it at $5. Right? If you bought at 5, you can sell at 20. Okay, the premium you won't know how to work out, but it's all in my mind, the calculation. Yeah. So that's how you make money on the way down. You buy, then you sell. Okay? But the other person who, when you want to buy, who do you buy from? That's another person opposite of contract. You think it will go down, there's another person who think it will be sideways to up. Right? There's always people who have different opinion. You think Apple will go down, the other person think it will be sideways to up. So he will collect the money from you. Okay? So what will be the simplest scenario in day-to-day life? Let's say you are buying a put option as insurance for your stock. Right? You already have Apple stock bought at 100. Now you pay $5 to give you the right to sell Apple at 100. You are buying insurance. This one is like the insurance provider. Understand? Let's say car insurance, right? You pay $3,000 to secure your car, which is worth $100,000 in case your car got lost. At least you want to get back the $100,000. Okay, there will be insurance company who do that, right? Understand? The insurance company, if you lose your car, what happen? Insurance company have to pay you the full price of the car, $100,000. He only received $3,000 premium from you. Understand? Yeah. So in a similar concept, you are the one who want to trade down. Someone think it's sideways to up. Okay, so then he will be the seller. This put option seller is a more advanced concept. If you don't understand, you are normal. If you can understand, you are pretty advanced. Okay, come and see me. Okay. Yeah. Okay, so forget about this. I was wondering whether I should even explain this. So, is it okay so far? Are you following so far? Raise your hand if you can still follow. Okay, thank you. Okay. All right. So now we already know what is call and put. Now let's talk about the concept of difference between stock and options. Yeah? For stock, in Malaysia, you have to buy a contract, right? Contract is one lot is 100 units. So in the stock, there's no lot concept. You can buy 1 unit, 5 units, 10 units of stock. You can even buy a fraction of a stock. You can buy half of Apple even. But in options for US market, there is still lot concept. Okay, one option contract give you the right to buy 100 units of the stock. Let's say when you buy one call options of Apple option, one call option of Apple stock, it gives you the right to buy 100 units of Apple. So the quote will be times 100. I will show you an example later. Okay, so that's the important one. One options contract, 100 units. Okay. All right. So now let me simplify it. For those of you who are traded, you may be able to understand this. Those of you who are not traded, I will do my best to explain. Let's say a simple stock chart. You want to do what we call a swing trade, right? What is a swing trade? Swing trade, you buy from the support. You get out near the resistance. In the US market, it may only take 1 to 2 weeks to reach a level like $10 like this. Okay? So if you are buying stock, that is where you will likely buy. If you think that the support, what is support? Support is the one that is tested many times and people likely to buy that. Okay? Then there's a resistance. I don't sell. A lot of people like to buy round number. I teach my students don't buy round number. Okay? So many people queue at the round number, only buy a. I also don't put 100. I put like 100.2126. Okay? I put odd number. But to simplify the calculation, I put, let's say you want to buy stock. Right? There's a support resistance. I buy 100.5. I sell at 109. Okay? So how much do I make? If you buy 100 units, right? You buy 100 units, it will cost you $10,050. Is that a lot of money? And USD, right? A lot of money. Okay? So the profit is, this is $9 profit. Do you agree? Yeah, you roughly 105, you sell, you make $9 for each unit. Okay, $9. Right? You just take this minus this, you get $9 times 100, you make 900 profit. So what is your return on investment? Your return on investment is you take your profit, divide by your cost. This is your cost. You take your profit, divide by your cost, is 9%. So it's 9% good. Let's look at, usually it takes about 2 weeks to reach that. 9% in 2 weeks, is it good? Consider very good, right? Yeah. So, but let's look at what if you don't use stock, you use option. Okay, this is what it will cost you. If you use call option, this contract only costs you about $4. Why $4? From my experience trading option, let's say this is a 2 months option, 2 months expiry. It usually will be around 3 to 6%. 3 to 6%. Depend on how volatile the stock is. So I'm using here about 4%. Okay? 4% of stock price. So 1 unit will be costing $4. But you need to buy one option contract, you must buy in 100 units. One option contract gives you the right to 100. So $4 times 100 only costs you 400 compared to 10,000. Can you see how it can be more affordable now? Yeah? Because now you're not buying the stock, you buy the right to buy the stock later. Can you see the difference? Yeah, it's like you pay a deposit that gives you the right to buy the stock later, just like a house. Yeah? Okay, so now, what is your profit? Okay, this is a tricky part. When the stock moves up $9, options doesn't move up $9 because you already pay in advance. Okay, there's a unique way options work. Okay, so it will go up roughly $4. Why $4? Once you ask option, you will know why. Based on this, yeah, when the stock price moves $9, usually options will move up about half of the stock price. Depend on which strike price. It's a bit sophisticated, but I just give you simplicity based on my experience trading option. It will be when stock price move $9, this will move around $4. Okay? Yeah. So $4 times 100 unit, $400 profit. The percentage return, you make 400, but your capital investment only 400. It's 100%. Can you see the difference? Yeah. But what's the best part of this? The best is when you're wrong. What if you are wrong? What if this stock go down to $90? Of course, you should have a stop loss, right? Like let's say go down to 90. In the stock, you will lose $10. Are you following so far? If after you buy about 100, it dropped to 90, you will lose $10. Okay, $10 per unit. Okay, $10 here. times 100 unit, you will lose 1,000 US. But options, the maximum you would ever lose is whatever you pay, which is 400. Even if the stock becomes zero, bankrupt, delisted, you only risk 400. Are you following? So now you understand why you can have a peace of mind with option. The moment you buy, you already know your maximum risk if you are a buyer. Buyer of the call, not the seller of the call. Can you understand so far? Can I see a show of hand? You understand how this works? Raise your hand. Okay, good, thank you. Okay, right? Simple enough? Okay, so this is why I love options, but you still need to make sure you understand. Before you learn option, at least you need to know how to trade the stock, right? At least you know where to buy, where to sell in the stock. Then the learning curve will be lesser, because then you need to just understand what is call, what is put, when to use calls and when to use put. Alright, so let me move on. Okay. Alright, so remember, as the stock price go up, the option premium will go up as well. Okay, because this option premium will become more and more valuable, right? Because the stock price went up, you still have the right to buy at the lower price. Okay, so let me show you an example here. This is where it gets a bit sophisticated. This is called the options chain or the option code. Okay, option code, and this is from moomoo, right? moomoo. You can because it's not launched in Malaysia yet. All right, sometimes within this year. So let me show you how to look at it. It looks complicated, but it's really straightforward. First, you have the stock we call it underlying, which is the stock. Let's say this is Apple. This is Apple current price, right? 220. This is the expiration date. You can see there are many choices of expiry. Example, remember, you can buy the right for 1 week, 1 month, 3 months, 1 year, 2 years. Okay, that's why the expiry happened, right? So this is expire in 12 days, expire in 40 days, expire in 68 days, expire in 131 days from today. Okay, yeah. So then on the left hand side will be how much it costs to buy call option. Right hand side, how much it costs to buy put option. And like the stock price, there's a bid and ask, right? Yeah, bid and ask. So there's a bid price and an ask price for option. So let me give you an example here. And the center is called the strike price. This is a bit technical, but this is your exercise price. Example, let's say, I give you a simple example now. Apple stock price is 220 right now, roughly 220. Let's say today, I want to buy a call option for Apple. I think Apple will go up. Okay, but I don't want to buy Apple stock because it's costly. How much does it cost to buy 100 units of Apple now? You take 220 times 100 units, it costs you 22,000 in what currency? US dollar. You convert to ringgit, is it a lot of money? Yeah. So, but instead of buying Apple stock, I decided to buy a call option for Apple. So how much does it cost? These are my choices of my right. I can choose to have the right to buy Apple at 220 or 210 or 215 or 225 or 230. Okay, so in standard, let me keep it simple. Let's say I want to have the right to buy Apple around the current stock price at 220. How much do I pay for the call option? It will be this. Yeah, so I look at the ask price. If I want to buy straight away, this is what I pay, $9.45. Okay, if I want to buy at the market. So $9.45, I do pay in 100. So times 100, $945. Right, $945 instead of paying 220 times 100 units. Can you see the big difference? And the best part of it, if I'm wrong, okay, this is based on how long do I have this right? I have 40 days. I have 40 days to have this right. Okay, so if I'm wrong, the stock didn't move up to that level, most I will ever lose is $9.45 times 100 for one contract. Are you following so far? Yeah. So the other one is, what if I have Apple stock bought at that price, but now I want to protect? How much do I need to pay to protect? This is where you will pay the, wait, doesn't come out, okay? Yeah, this put option, if I want to protect stock, I will pay $7.20. Okay, this is a put option. By paying $7.20, it gives me the right to sell Apple at 220. This is my protection price. It's called the strike price. Okay, it gives me the right to sell at this even if Apple become $100. Are you following? Yeah. So it gave me a peace of mind. That's for protection. Or I can also buy this to trade down. Right? I won't go there, it's a bit sophisticated. So let me show you how do you make. So now, let's say you want to buy. I pay $9.45 expecting Apple to go up. And let's say Apple $10 from 220 become 230. You will see that when you go back to this code, this price will go up. It will go up to roughly how much? So I want to show you. I actually hide some. There's something called delta here, which is supposed to keep it simple. When go up $10, this one will roughly go up around $5. That's how it works based on delta. Okay. So keep it simple. So you will see. Let's say Apple become 230. Now you will see this plus $5 will become $14.45. Because this contract become more valuable. Apple already 230. You still have the right to buy Apple at 220. Understand? Yeah, so what do? You don't need to exercise. You just right click, sell, and you make the money. Understand? You buy at 945, one contract 945. When you sell it, you just sell at the latest quote there, $14.45, and you make the money. Simple, but of course you need to learn how to use the platform. Alright, so that's in. But let's say you think it won't go up so fast. What can you do? You can choose a longer expiry. So you can choose 131 days. You can buy January next year, which is more liquid. Okay, now it's September. You can buy January next year. Give you more time for Apple to go up. But more time should cost you more or less? Should be more. So you can see, if I buy the expiry for October, right, which is only 40 days, I have to pay $9.45 for this strike. But if I go longer, which is January, I will pay more. But I have more time to get it right. Understand? Yeah, so how you make the decisions is important based on how you view the stock bullishness. So that's why understanding how the stock price will move come first, then you apply the right option strategy. Can you understand so far? Okay. Alright, so let me click. Alright, so now I'm going to go through the last part. I need to go faster, okay, because I have quite a number of slides. So this is my actual trade to illustrate. Number one, how does it provide leverage? This is a 𝘂𝘂 call option. Do you know what is 𝘂𝘂? 𝘂𝘂 is a parent company for moomoo. Okay, yeah, this is a moomoo, right? Yeah, so this is a parent company. It's listed in Nasdaq Stock Exchange. So I trade it as a swing trade in this year, March. I traded 𝘂𝘂 in March. Okay, so I bought, instead of buying 𝘂𝘂 share at a time, I could have buy at 52. Like this is a swing trade. You look at it. This is a support, the resistance. I buy here and I sell here. Simple. So if I can use stock to buy as well. I can buy stock at 52, I sell at 64, I still make money, right? But instead of buying stock, I buy options. So how much is the option? If I buy stock, it costs me 52. I buy option, costs me 741 only. So when 𝘂𝘂 share went up to 64, can you see? I was able to sell this call option at $16. You know, in the same, you look at the option chain. Remember the option chain just now? Right? The price will change from 741, my buy price. It will change to 16. Then I just right click sell and make the money. So let me show you the example. If I buy stock, I will make $12. Still good return. 23% in how many days? I buy here 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days. 2 weeks. Okay, so in 2 weeks I can still make 23% from a swing trade. But if I use options, right, my selling price for option is 16.14. My buying price here, I make $8.73. And this one is 118%. But the best thing is, if I'm wrong, I will lose less. I can have peace of mind. Yeah, I mean that's my max loss, whatever I pay. On top of that, you can still put a stop loss to limit it. Okay, to limit, you don't want to lose the entire 741. All right, can you understand? So even though you have the right to exercise, but you have to really exercise. You just sell in the market. So now my next example. However, 𝘂𝘂 is a lower price stock. The options also cheaper. But when it comes to Microsoft, the price is more expensive. Okay, so let me show you. Let's say you want to trade Microsoft here. When it's moderate bullish, you can use a combination. Okay, and I want to sell it over here. Let me see. Yeah, let's say I want to buy Microsoft here and sell it here is moderate bullish, but the cost is more expensive. It cost me $33. Yeah, it cost me here. This is my this is the price. It cost me where's the buy price? Sorry, here. 50. Just hold on. Buy sell. Yeah. It cost me $33.11. It's so much more costlier. So options is fantastic. Right? I don't want to pay $33. What if I'm wrong? I can buy a call option and I can sell another call option to make it cheaper. Okay? So I buy a call option to give me the right to buy at 370. I sell another contract at 400. So I reduce my buying price. This is a bit advanced. So instead of using one call option contract, I combine two contracts to make my options cheaper. But the way you look at it, you buy as a combination, you sell as a combination. So to keep it simple, because a lot of you are new to options, you may not be able to make sense of this. So if I buy stock, this is if I buy stock, right, I will pay more because I will have paid 315 here and I sell here. My percentage return is very small. But when I use options here, combination, I still make 70%. Okay, 70%. And my risk per contract limited to $14 for Microsoft. Okay, if you buy Microsoft, the stock is 365. Okay, you can lose a lot, right? If the stock drop 10%. But here, my risk limited to whatever I pay, $14.18 on it. All right, so and last but not least, okay, I don't have time to cover so many. I have 12 minutes, okay. So this is a little bit more advanced, which is called hedging, right? So now these days, there's so many economic indicators, inflation indicators in the US. So I want to have peace of mind, no matter what happens, okay? Don't need to monitor so much. So at this point here, I know that there's a lot of announcement here, okay? A lot of economic indicators. There's also earnings announcement here. I just want to hedge my entire portfolio. I have a lot of tech stock. Okay, this is a smaller position of hedge. So what I do is, I buy 10 contracts of put option. This is put option. And the strike price, a bit lower, 490. So what does it mean? When I buy a put option of 490, it gives me the right to sell QQQ. QQQ is the Nasdaq 100 Index ETF. Okay, it gives me the right to sell QQQ at 490, even if the market crashed to 455. Understand? Yeah. So I bought it at this price. Sorry. Yeah, I bought it at this price. I bought it at 13,749 cents. The protection. I bought the protection at 37.79. So when the stock go up and come back to this level, I make money from the put. Yeah, because the stock came down. I bought it here, then it fluctuate. After that, the market came down. Right? Put option, you make money on which direction? Up or down? Down. So it comes down, I make money. I buy the put at 13.79, I sell it at 27, so I make the difference here. So this contract make me $12,700 US within this time frame, and I have a peace of mind on my account. Are you following so far? Okay. Normally this take me a few hours to teach. Now it's an express. Okay. Yeah. So the last part is income generation. How do you make money even though the stock stays sideways? Okay. There will be times where you see a stock like that. This is 𝗀𝗃. Remember, with the interest rate cut, real estate is one of the sector that is likely to go up. Okay, interest rate cut, lower housing loan interest. So I bought into 𝗀𝗃. But this stock has been going sideways for a while because haven't confirmed rate cut, right? So because of that, I may consider that what if it's sideways for a while. So this is a trend reversal. There's a spike. I enter it here. Okay, enter it here. So, but I know there's another support here. So what I do is, I buy the stock. This is a different style. This is for investor. You buy the stock and you sell an option. If the stock stays sideways, every month you collect rental income. The concept is like you buy property, right? After you buy the property, every month you rent it out, right? Then you have the income, even though the property price don't go up. In options, right, you can do the same thing. You buy the stock, then you sell the option. Like sell options, you create income, right? Yeah, so this is what I do. I buy the stock at around 150, right? Technically it's 150.11. As I mentioned, I don't buy round number. Then I sell the call option at this price. I collected, when I sell, I collected $7.44. Okay, what it means in simple layman term is, even if this stock stays sideways until the expiry, I will still make $7.44. even if this stock stays sideways. So, and if the stock go up, can you see here there's a 170 exercise price? If the stock go up above 170, which is here, I will not make more. Okay, so there's a pro and cons. So I still have the room for this stock to move up $20. I can make $20 from the stock, plus I can make $7.44 from the option. So why do I do that? There's some uncertainty at this time. And I want to protect, after I buy, what if it come down to the support here? I collected $7.44. It's sufficient to protect me until the support. Okay? Yeah, so this is a method for investor. You can do this on a monthly basis. What I do is I like to collect half-year income and 1 year rental. Okay, so you can choose I want to sell half year or 1 year. The longer you sell the option, the more income you collect. That income bring down the cost of your stock. It bring down your break even for the stock, and even though the stock stays sideways, you still make money. I mean, you won't be able to understand the whole mechanism, but I just show you this is possible. Okay, and this is my exact trade. You will find it a bit odd because you will see one part make money, one part lose money, but you need to look at the profit as a combination. Okay, so I'm going to wrap up here. Recap. So now, after I explain all this, just to recap, why option? What's the benefit? It reduces the cost because it costs you less money, and that increases your ROI. And your maximum risk defined by the premium you pay. You will not lose more than what you pay. So you know your max risk upfront, even if the stock go bankrupt. Okay. Of course, there's also risky way to trade options, which I don't encourage. Okay. I use the protected way. There are so many ways to protect the risk, right? And you can generate income in so many ways. All right. So now I show you. Those are the three major ones. But the best part of option is the versatility. Why I love options? The most powerful financial instrument on planet Earth. I've traded stock options, forex, futures, CFD. This is the most powerful. Why? It gives you the limited risk and give you the sideways income, and you can trade in so many ways. For example, you can buy a call option to trade up, right? Option to trade up. You can buy a put option to trade down. You have a way to trade as long as it says sideways up, you can make money. Or there's a way to trade sideways down. Or you can say as long as the stock stay in this range, you make money. Or if the stock break out, you make money. So these two combining different way to use option, right? So the same chart, you can trade it in so many ways. Okay, of course, you need to learn it from the single option first, then the combination. And it may take a few years to master until all the rest of it, right? But the basic one can just take a few months, all right? So this will show you all the different period where you, example, right? When do you trade up? Right, when this downtrend about to move up, this is where you buy call option. When do you trade down? When down, you buy option. Right? Then here could be sideways to up. Sideways to up, you use it's called sideways and up, you make money. Or here you can trade if sideways to down. There's a way sideways to down. So it enhances your overall success rate rather than just trading must go up to make money. It goes to make money. You can define an option strategy like that, okay? All right, so let's move on. But I want to also highlight the of what you need to do when you trade option, okay? So one of it is you need to be aware that as a buyer, if the stock lose momentum, let's say you pay $5 to buy Apple share, right? Let's say you pay $5 premium to give right to buy Apple at let's say 100. But Apple don't move, right? You buy a 2 months expiry. Apple after a while go up, sideways. Your $5 premium may become $3, become $2. If you still in denial, actually from the chart you know you need to cut, you need to close it. But you are still hoping. Left $1 premium, you still hold on. You wait until the last day, it will become 0. If Apple still stay at 100, right? Because the contract give you the right to buy Apple at 100. Who wants to pay more when the stock is still 100? Understand? So you need to understand, buyer, you need to understand. This is the concept. You need to know when is the right time to buy, when to sell it, when the momentum drop. Okay. All right. So how do you tackle this? You ensure you have the right strategy, right market condition. Don't just simply buy, call option. The other one is it requires more skill, right? From what I explained, do you think it requires more skill? First, you need to understand stock. But once you understand stock, call and put basic one is easier to understand. Okay. The advanced one takes some time. Okay, so what you need to do is, so it can still be overcome with proper training. Example, don't become a naked seller. That makes selling without protected. That was the biggest warning I want to give to you. It's over temptation because it costs so little to buy, right? Instead of paying $10,000 to buy the share, you only pay $400 on the first example. So end up what? A lot of people will use their entire account and buy everything they can with the $400. If that's the case, if you're wrong, you can still lose the entire account. That's not the right way to use leverage, okay? So you still need to make sure that if you entirely lose the $400, how many percent of your account? We limit it to maximum 1 to 2%. Okay, so because options give you maximum protection, you can go for 2%. Based on stop loss, should be 1%. Because put stop loss can still gap. Okay, yeah. So there is a temptation you need to watch out. You have the power, but don't overuse it. Okay, yeah. Don't buy too many contracts, and so always have a risk management. So this is an important warning if you want to go into options. All right. Okay, so now as I mentioned, you don't straight away go into option. Right? You need a complete framework for investing, a proper approach to investing and trading. We have the most complete education process for this. Every trading style, we have long-term investing, mid-term trend trading, short-term swing trading, and also intraday. Okay, and each one has its entry exit rule. Okay, there's a one-page summary of the process for each one. So you need to know that first. Okay, it's just a financial instrument. Example, you need a way to select stock, right? You cannot just simply buy a call option. Right? What options do you buy? So you need a way to select the right stock that grows. After that, you need to look at the stock chart. Based on the stock chart, right, you need to draw your support resistance trend line. Where do I buy? Where do I sell? Where's my stop loss first? Right? Where do I get out? After that, you need to learn to protect. This is where options come in. So if you don't know option, you put stop loss. If you know option, you can buy a call. Okay, that already give you limited risk. Then you can multiply with options. Right? This is where multiply, you can, two ways to multiply. You do more short-term strategy, like you do swing trade. So once you get out of the trade, you can recycle the money. Or you trade intraday, okay? Yeah. So how you multiply, you can use options because options use lesser capital. Okay, so it can multiply faster. Or you can use stock with margin, which moomoo also provide. Right, so you still need a systematic, right? Options at here and here. Right, that means on the same stock chart, you can use stock to buy, you can buy stock with margin, or you can buy a call option. Okay, at the basic. Once you get more advanced, you can buy a combination option. You can trade it. If it go up, make money. Or sideways up, you make money. Or as long as stay above here, you make money. Or stay within ratio, you make money. There are so many ways to trade options once you understand it. Okay? Yeah. So that's all I have to cover. Let me, one more page. Last one. Cannot go. Last page, right? So I'm not sure whether you can talk to me offline. We do.
Right,
okay.
So, ladies and gentlemen, first a big round of applause to Kathlyn. Thank you so
Exhausted.
much. I let me take a breather for a while. Take a deep breath for a while.
Okay.
She said, you know, she wants to teach all of us all this information, trying to cram everything in an hour.
Advanced course in layman terms.
Yeah, man. And I'm really impressed. I hope you guys have learned a lot, and I hope you've got questions. But we are only limiting it to how many? 2 questions. So, anyone got questions? Put your hands up, and we'll pass you a microphone. Take
Anyone?
this opportunity right now. Anyone? Anyone with questions?
Yes, over there. Yeah, mention your name first so I can.
My name is Rizwan.
Okay.
What is the bond stock and option?
Okay, the pro and cons. The question is, what is the pro and cons between stocks and options? Earlier, when you buy stocks, right, you pay more. Right? Let's say you buy $100 stock, you have to pay $100. Options, you pay roughly short-term options between 2 to 8%. Short-term means between 1 month to 2 months. If you buy a 1 year right, because options have expiry, if you want to buy a 1 year right, it can be between 8 to 20% of stock price. So the benefit will be you use less money, right? It's called leverage. The second one is stock, you protect based on stop loss. Okay. Whereas for options, whatever you pay, that's the maximum risk. On top of that, you can still use stop loss. So you have a better peace of mind. Yeah. So that's the two main one. The third one is options have expiry and strike price. Like stock is more simple. You can hold forever, it won't expire. So when you want to trade options, you need to be aware of the expiry date. We don't wait until the last minute to sell. The moment it reaches our target price, we sell. Yeah.
option don't have dividend, right?
Okay, yes, good one. Options don't have dividend. When you trade options, your goal is not dividend. Yeah. So because you haven't turned it into the stock. But if you use the last strategy called covered call, where you buy stock and you sell option, you have the best of both worlds. Because you have the stock, you will collect dividend. On top of that, every month, you can collect the options premium. Yeah, so you can combine stocks and options together. Okay?
Thank
So,
you very much.
yeah.
One more question from the audience.
Yes.
The
Yeah.
gentleman over here.
Yeah.
What is the optimum days to expiration that you're choosing?
Okay, optimum days to expiration depend on your trading strategy, right? So first you need to define your trading horizon. Are you a long-term investor, right? Then you will use the 1 to 2 years. Are you a trend trader? You will use 3 to 9 months. Are you a swing trader? You will use about 2 to 3 months. Right? If you are intraday, you use about 3 to 4 weeks. Yeah. But there are people who trade. There are so many ways to trade. Some people trade the 0 day to expiration, right? Or post earning, they are looking for the premium string after the speculation. That is a more advanced way, right? So there are actually more than 100 ways to trade it. Yeah. But what I'm talking to you is the more simple, straightforward, based on trading horizon. Yeah. Okay.
All right,
Yeah,
thank you
all right.
very much. A
There's
big round of applause.
I have one more last slide.
Oh, last
just one
slide.
like just
Okay.
okay. Before that, what do you think about options right now? Okay, can understand so far? I don't know whether I lost a lot of you. If you can understand, raise your hand. Okay, good. But right, this is a pretty advanced instrument, so I applaud all of you can understand within a short time, 1 hour. Okay, so remember I mentioned quite a lot of examples here. The examples are chosen to portray the education. So please don't go and buy the on Monday or buy the Microsoft or those stock I mentioned, LEN. Okay, you need to learn it the right way. But if you have, if you are interested to learn more, who is interested to learn more? Raise your hand. Whether it's the stock market, we also have the foundation. If you don't know anything yet, go for the foundation course first. We have long-term investing, mid-term trend trading, swing trading, intraday. Okay, we have CFD and options stock with margin. So you can scan this, connect to us. Right, we have a WhatsApp that can talk to our team. Okay, and on the we have a webinar, 3-hour free webinar to let you understand a systematic the stock market. Okay, all right. Thank you very much.
Thank you very much, Kathlyn. So a big round of applause. Okay, ladies and gentlemen, I'd like to ask you all to remain where you are. Kathlyn, why don't you join the crowd as we will be calling